Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of Goldman Sachs, ticker symbol GS. This continues our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average. This is the 12th video in that series. You can see a link in the description below to all those videos. Once we complete our analysis, we're going to try to build 3 different portfolios, a value, a growth, and a dividend portfolio. So we can break Goldman's business into 4 main segments: institutional client services, investment banking, investing and lending, and investment management. And as you can see, this is the breakdown of revenue according to segments. Institutional client services is the largest segment. They're the blue bars, but they're getting much closer to the other segments as far as revenue goes. Now, the goal of the research that I did on Goldman Sachs was to see if they're worth adding to one of our portfolios. So I'm going to jump ahead. Before we dive into what they do, I'm going to jump ahead to this revenue chart. Now, when I got to analyzing the financial statements, it surprised me to see revenue that over the past 10 years hasn't done a lot as far as a way of growth. I expected their revenue to be in a much more uptrend than it has been, because I know that a lot of what they do is tied to money management. And if we look at this chart with the S&P 500 on top of it, we can see that the S&P has really done quite well, and revenue didn't seem to match what they were doing. Now, if we were to add earnings per share to that, it looks like earnings per share was up in 2017, but as you can see, it's not terribly impressive. Now, this leads me to what the stock has done. I was curious what the stock price did, so here's a 10-year chart of Goldman Sachs, and as we could tell, it's not bad, but it's not great. In fact, the total return for Goldman Sachs for the past 10 years was about 176%, which is a bit over 10.5% a year. Compare that to the S&P 500, which is up almost 250%, and that's about 13% per year. Okay, so that's what's happened up until now. But if we're going to add it to the portfolio, I think it's important that we base that on what we believe will happen, not necessarily what has happened. Perhaps their underperforming over the past decade is an opportunity. So let's press forward. So there's been some big changes at Goldman. They have a new CEO, David Solomon, new COO, John Waldron, and a new CFO, Stephen Scherr. So Solomon, the CEO, he's worked with Waldron before. And the real question when Solomon took over for Lloyd Blankfein was, would they focus more on investment banking, since both Waldron and Solomon are investment bankers? So a few weeks ago, the new CFO, Stephen Scherr, he did a presentation with Merrill Lynch, and there he laid out where Goldman would be heading. And this slide, this comes directly from that presentation. This is the $5 billion growth initiatives that they started before this team took over, and this team has confirmed that they intend on keeping this in place. Now we can see that the largest revenue creator so far is from the investing and lending division. And this division focuses on institutional lending and their Marcus brands. Marcus offers high yield savings and loans to individuals. So ultimately, this division is more like your typical bank. And this is important because, as management has recently said, this should add stability to revenue, so they intend to grow this division, and this should be a good thing. Okay, now moving over to the investment banking division. We can see that this, under performance indicators, they have $40 billion in new deal volume. And I think that this is possible given the current environment. This chart here, this is the deals done globally since 2008. This includes mergers and acquisitions, buybacks, spin-offs, joint ventures, and things like that. And all of this is where this division plays for Goldman Sachs. Now, this isn't just Goldman Sachs. This is worldwide, all the companies. And the blue bars are the dollar volume of deals. So the most recent number was a bit over $5 trillion. And the red line is a number of deals that have actually been executed. Investment banking has been rather consistent for Goldman over the past few years, and we expect it to continue to do so. And the top 3 players in investment banking is really Goldman Sachs, Morgan Stanley, and JP Morgan. And unfortunately, this intense competition can often lead to companies lowering fees. That's why we saw a dip in revenue. And I think this is something that we're going to want to watch. And if we look at the revenue chart, we can see that this segment has been fairly good. They're the red bars. So what's really been a killer for Goldman is their institutional client services. They're the blue bars. The institutional client services business does a few different things. One of the key things they do is trading for clients. Trading is both very volatile and It's an environment that has evolved rapidly as technology has developed. This is where Goldman Sachs investment research lives. They provide research and hopefully execute more trades. But as we can see from the revenue chart, it's been declining. But the good news is that although it's been declining over the past few years, the first 3 quarters of 2018 have already almost met what 2017 did. And this is primarily because trading, specifically in the US, has been very volatile in the stock market, and a volatile stock market is a good thing for trading. Now, this leads us to the investment management division. Once again, you can see that the investment management division, the purple bars, has been mostly consistent. Investment management has long been a cornerstone of Goldman Sachs, and they control north of $1.4 trillion split between institutions, high net worth individuals, and third parties. So now what? Well, frankly, I really like what the new management team is putting in place. Sure, the past 10 years have been somewhat, call it, stagnant from both a growth perspective and a revenue perspective. But for me, I think that the direction that management is heading, gearing up for a more consistent growth profile, I think is a good thing. I like their investing and lending business. I think that should add some consistency. I like the position of the investment banking business. I think that they have room for growth. I also like the investment management division, which seems to be pushing to get the other divisions in the company to add more assets under management. Overall, I think that this has the potential to lead to a productive growth profile over the next couple of years. And ultimately, it looks like the next quarter or so should do well for Goldman from a stock perspective. Volatility has remained high, which should bode well for their trading business. Management has stated their desire to find good acquisitions that could add to growth, and I think we might see an announcement in that area, and if we do that, could help the stock. Plus, management has said that they're trying to be more transparent going forward, and I think that this is a good thing. Generally, the more transparent a company is, the easier it is for analysts and potential investors to value, and that should ultimately lead to more, in theory, should lead to more investments in Goldman. So the question now is, what do we think Goldman is worth? Well, their current forward PE is about 8x. Morgan Stanley's at about 9x, and JP Morgan is at about 11x. That being said, if we take the average of JP Morgan and Morgan Stanley, it gives us 10x. And that's right where the S&P 500 Financials Index is. So I think that's a reasonable multiple to use. But before we jump ahead and just use that one, there's another valuation tool that I think is very useful for financial companies, and it's called the sustainable growth rate. The sustainable growth rate is the rate that earnings and dividends can keep growing at. Basically, we take the company's return on equity and we multiply that by their retention rate. The retention rate is how much the company keeps after it pays out the dividends. So if they have a net income of 100 and they pay out 30, well, their retention rate would be 70 since they've retained 70% of their net income. Now, I thought of looking at the sustainable growth rate because when I was reading through the 10K and the 10Q, management kept bringing up how important return on equity was to them. And I know that a sustainable growth rate is a good tool for financial companies like insurance companies, banks, and financial companies like Goldman Sachs. So here's how we calculated Goldman's sustainable growth rate. For 2017, they had a return on equity of about 5.05. They retained about 68% of their earnings. That means that they paid out a bit over 32%. That gave them a sustainable growth rate of 3.43. Now, if we look at Morgan Stanley, we can see that they have a sustainable growth rate of 5.81, and JP Morgan comes in at 6.56. So what does this tell us? Well, the sustainable growth rate ultimately tells us how fast the company can grow, assuming they don't issue any more stock or take on any more debt. Now, there are a few ways that they can change their sustainable growth rate. They can improve their return on equity, they can lower the percentage of net income that they pay out as dividends, or they can issue more debt or stock. Now, I think that this is important because I feel that it helps us gauge where Goldman should be trading relative to peers. And although the industry is trading at an average PE of 10x, I think that with this new information, that Goldman should be trading at the lower end of that PE. How about we call it 9x? And with 2019 expected EPS of $25.58, that implies that Goldman should be trading at right around $230 per share. The current price is just below $200 per share. So there appears to be some upside. So does it belong in any of our portfolios? Well, I think probably not the growth portfolio. Unless the new management team can do something to really turn things around, I don't think it makes sense there. The dividend portfolio, maybe. They have a yield of about 1.5%. But knowing that they're in a transition period right now, I think it might be better to avoid them from a dividend perspective. That being said, it is interesting to note that they have some preferred shares that are currently trading north of 5%. So that could be interesting to add that from a dividend perspective. Now, how about the value portfolio? I think that there's some real risk in Goldman staying stagnant over the next few years. That being said, I think that if we're trying to build a great portfolio, we might be better off sticking with companies that we have extreme confidence in. So with that in mind, I think that if we were going to add this to the value portfolio, this stock, there would have to be significantly more than the 15 or so % upside that we currently calculated. If it keeps falling, if the stock keeps falling, I think that this could get interesting. But let me know what you think. I know a lot of people love Goldman Sachs, and I was very surprised to see how little their revenue has gone up. I fully expected that they were going to be in a solid uptrend for the entire past 10 or so years. That being said, this could be potential opportunity for us. So let me know what you think in the comments below. Would you add this to any of the portfolios? And is there anything in the research that I didn't touch on that you think is important? If so, post them in the comments below. And if you haven't done so yet, hit the subscribe button and I'll see you in the next video. Thanks.